In this section, you will learn about the lending institution, Part 1. Financial institutions are key to purchase real estate. Banks, credit unions, mortgage brokers, and other financial institutions, lenders, play an essential role in purchasing real estate property. If you plan to finance your purchase, your first step should always be to consult a lender to explore your loan options. B. Are you paying cash? Then no lender needed. If you intend to pay cash for a property and cover all closing costs up front, you do not need the services of a bank, credit union, mortgage broker, or other financial institution. A straightforward cash transaction can streamline the purchasing process significantly. C. Types of mortgage loans in the United States. The U.S. offers several types of mortgage loans to meet diverse buyer needs. Popular loan types include FHA loans, backed by the Federal Housing Administration and designed for first-time homebuyers with lower credit scores or smaller down payments. VA loans, exclusive to veterans, active duty service members, and qualifying spouses, offering competitive rates and no down payment. Conventional conforming loans, loans that meet Fannie Mae and Freddie Mac standards. Conventional non-conforming loans, for higher value homes or unique borrower profiles, for example jumbo loans. Alternative mortgage options not endorsed by MYDAR, but available when no other choice exists, include non-QM, non-qualified mortgage loans. While MYDAR does not promote these loans, they remain an option for prospective borrowers facing limited alternatives. Ultimately, the decision is yours, formerly known in early 2000s as Band-Aid loans. Hard money loans, truly for real estate investors. Private loans, typically for short-term financing or investment purposes, with less stringent qualification requirements but higher interest rates. Note: mortgage interest rates and qualification criteria are subject to frequent changes due to factors such as market trends, government policy updates, and economic conditions. D. The factors that may affect the mortgage industry. The requirements and availability of mortgage loans are influenced by the following. The domestic and global economy, including inflation and market stability. Major events such as legislative changes, pandemics, or geopolitical developments. These dynamic factors underscore the importance of staying informed and working closely with your lender. What are the basic requirements to purchase a property? To qualify for a mortgage loan, you must meet the following core requirements. One, creditworthiness, a credit history and score that meet the lender's criteria. 2, employment and income, verifiable employment and stable income to demonstrate your ability to repay the loan. 3, legal status, proof of legal status in the United States. Each lender may have additional specific criteria, so it's crucial to consult them for details tailored to your circumstances. Key reminder: mortgage loan programs are ever evolving. Programs available today may not be tomorrow due to regulatory updates or market shifts. Always seek up-to-date advice from your lender or a real estate professional. One, traditional credit. Traditional credit refers to your credit score, which ranges from 0 to 900 points, the highest possible score. It is also known as your FICO score. In the United States, 3 major credit bureaus, Equifax, Experian, and TransUnion, maintain records of your credit information. These bureaus document the following: your creditors, credit history, credit limits granted, current debts owed, timely or untimely payments. And this information is consolidated into your credit report, which is accessible to potential new creditors. The key points. 1. Reporting by creditors. Banks, credit unions, financial institutions, and many merchants, for example furniture stores, report your payment activity to one or more of the 3 credit bureaus. This includes whether payments are made on time. 2. Special financing options. If your credit score is low, banks, credit unions, or other financial institutions, lenders, may still offer financing options. However, these typically come with higher interest rates. 3. Impact of credit scores. Your FICO score determines the interest rates you receive on financial products, including mortgage loans, auto loans, personal loans, credit cards, and charge cards. It can also influence employment opportunities in some cases. 4. Maintaining good credit. Timely payments and responsible credit usage lead to a higher FICO score and better interest rates. By understanding and effectively utilizing alternative credit, borrowers without traditional credit histories can still access homeownership opportunities through federally compliant mortgage programs. Late payments, excessive debt, or other negative factors lower your score, resulting in higher interest rates. What happens if you don't have traditional credit? If you lack traditional credit, you can rely on alternative credit to demonstrate your financial responsibility. What is alternative credit? Alternative credit refers to credit used by buyers or borrowers who do not have any form of traditional credit, such as credit cards, loans, or lines of credit reported to the three major credit bureaus, Equifax, Experian, and TransUnion. To qualify as alternative credit, the borrower must demonstrate a minimum of 12 consecutive months of on-time payments in good standing at the time they are applying for a mortgage loan. Examples of alternative credit sources. 1. Small merchants. Businesses that typically do not report to the credit bureaus, such as jewelry stores, automotive dealers, agencies, furniture stores, small and independent retailers. 2. Utility companies. Utility providers generally do not report on-time payments to credit bureaus, including electricity companies, water companies, gas companies, and telephone internet providers. Important note: while on-time payments are not reported, late or missed payments may be referred to collection agencies, which will negatively impact your credit score. How does alternative credit works? If you maintain timely payments with small merchants or utility companies, they can provide letters of good standing verifying your excellent payment history. These letters serve as evidence of creditworthiness and are submitted to your lender during the mortgage loan application process. Federal Housing Administration (FHA) and other loans. FHA loans and certain other mortgage programs may accept alternative credit documentation. However, borrowers must still meet all other lending requirements, including income verification, employment history, and debt-to-income ratio limits. Updated regulatory requirements. Alternative credit letters must reflect at least 12 months of consecutive payments in good standing with no lapses. Borrowers are encouraged to provide original or certified documentation from merchants or utility companies to avoid delays. Lenders may request additional validation of alternative credit sources to ensure compliance with federal and state guidelines. Here are some tips for the borrowers. 1. Request alternative credit letters early. Small merchants and utility companies may take 10 to 45 days to process and deliver these letters. Start gathering documentation before initiating the mortgage loan process to avoid delays. Two, consult a mortgage professional. Some loan programs that previously accepted alternative credit may no longer be available. Speak with a licensed mortgage consultant to confirm whether these options align with your current financial situation and goals. Three, maintain payment on time. Ensure all payments are made on time to maintain eligibility for alternative credit-based loans. Keep detailed records of all transactions with merchants and utility companies. By understanding and effectively utilizing alternative credit, borrowers without traditional credit histories can still access homeownership opportunities through federally compliant mortgage programs. Video completed. Continue to the next module to keep learning.